Well, personally, I think that it will be settled with negotiations. I don't think they'll go as far as really launching a trade war, especially since the US has much more to lose than China. So I think that Mr. Trump and his ill-informed advisors, in particular Peter Navarro, will come to their senses and realize that actually the US trade deficit is due to many reasons and not just because China has stolen property rights and so forth and so on. This is, I mean, really, from an economic perspective, complete nonsense.
Yeah, Dr. Faber, I saw a statistic the other day that said it's only 0.3% of all trade in the world has been affected by these tariffs. So it sounds like a lot of headlines for not a lot of the actual trade that goes on.
Yes, correct. Now it could escalate. As I said, I think if the Trump team would talk to some experts, they would tell them that actually the US has much more to lose. And just think about it. Let's say we trade together. I'm the producer. I manufacture all kinds of things, and you're the buyer. So as a result of that, I sell more goods to you than I'm buying from you. But in order to finance that, the US or you send me a bank note. So I'm working with my workers in sweatshops, and over time I build up my productivity and technology because I continuously invest money. And you consume, and you have ill-conceived economic policies that actually stimulate consumption and do not stimulate capital investment. But in turn, you give me a bank note that over time is depreciating. Now, please tell me, who has the better deal? You print a money bank note, and I get one bank note in return for all the work I do. Well, I think you have a pretty good deal when you look at it objectively. So about the US, in theory, practically considered, I would let China make Brexit, just send them over bills. What can they do with these bills? They can come back to the US and buy real estate and so on. But in a trade war, consumer goods in the US will become more expensive. And if they declare the trade war just against China, then other countries will supply the goods to the US at even lower price. But assuming they declare a trade war against everybody and all consumer prices go up, do you think it's particularly desirable for the US consumer and for the economy? Number two, who is buying real estate in the US and treasury bills and stocks? Foreigners. So if China becomes pissed off at the US, they can tell the citizens, from now on, you're no longer allowed to purchase real estate in the US. And then you'll see what happens to the real estate market in Southern California, in San Francisco, and in New York. All going to be very brief.
So, Dr. Faber, as you look out right now, are you thinking that the stock market has turned over? Is it on a downside now? Is it moving toward a bear market, possible recession?
Well, I suppose some stocks are already in bear markets, but it's not yet a confirmed bear market. If you remember well, end of December 2015 to February 10, 2016, the stock market in the US went down, I think it was 21%, and then it rebounded. So we haven't had a 21% decline yet. We had a decline in year of around 11% or so, 12%, but no 20% decline. And even if we had 20% decline, it would not imply that we are in a bear market yet. After this kind of huge bull market, you could say it's a correction. It's a healthy correction. But my sense is that if the market drops 20%, there will be a lot of margin calls, because a lot of people bought recently stocks on margin, or they bought them with credit cards. You have to see the most recent buyers of FANG and FANG-related stocks, the Facebook, Apples, and Amazon, Netflix, and so forth, and most Tesla, the same people that buy cryptocurrency. Also, 30% of them are bought on margin. And they get the margin call on cryptos, and they get margin calls on stocks. But these margin calls do not come right away because they haven't got big losses. These margin calls will really start to flow once the market is down like 20%. And then we could see a big drift. That possibility. Now, short term, very short term, the market is slightly oversold. Not grossly oversold, but it is oversold. So what would happen? April is usually a month of seasonal strength. And then May, June, July are markets or periods of seasonal weakness. And we get usually in July, summer rally, frequently no new high. So I think this market, for now at least, we can assume they peaked out January 26, 2018. S&P 2,870. Because we're down now more than 200 points. To really make it too high, it's not going to be all that easy.
Now, Dr. Faber, you have talked about in the past that you see better value, not in the U.S., but you see better value stocks in Europe and Asia. Can you explain why?
Well, I mean, I think that in Asia, I just had a drink tonight with a micro analyst. In other words, he visits maybe 50 companies in a week or 2 weeks, and he talks to people from a corporate point of view. And we discussed, the markets in Thailand, among others. And I said to him, I think the Thai market is not terribly expensive, but it's not a bargain either. We're not, the markets in Asia had several buying opportunities that were great. After the financial crisis of 1997, 1998, there was a huge buying opportunity, a lifetime opportunity. And the markets rallied, not very strongly, but after 2003, there was a second buying opportunity because we had the Nasdaq crash back down to other market. The 2003 was a buying opportunity, and then after the financial crisis of 2007, 2008, until say March 2009, there was the last big buying opportunity. And since then, markets have gone up a lot. Vietnam last year was up 50%, actually 55%. And the other Asian markets were all up between 25 and 30%. So the markets are no longer that inexpensive. And with this potential of a trade war, it could also affect the Asian economies to some extent, not so badly, to some extent. So I think it's better value than the US, as is Europe, but it's not the bargain level. Mm-hmm. And then we have to also look at what kind of stock. I believe the last few years were very favorable index funds and for ETFs. I think we're moving back now into a time where active managers will do far better. I mean, if I had to give out money tomorrow, I would give it to an active manager and not into an index fund.
Right. So, Dr. Faber, how do you see precious metals in the medium to long term? How do you see it going for them?
Well, I mean, I hold gold, and I think that silver has at the moment the best upside potential, and I also hold platinum, but less than gold. And in the long run, I think they will move higher. But at the same time, I have to say that I'm not impressed by the market action of either of any precious metal. I think they're not acting that well, considering all the issues that we have in the world. In my opinion, they should be higher. Now, you may argue, well, there's no interest in gold. Yes, but what will trigger the interest to come back, and when? I think the interest will come back. But is it coming back tomorrow, or in 3 months, or 6 months, or 9 months? I don't know. I think the triggering point will be when investors realize how big the deficits are going to be in the US. And I think the trigger will also be when the dollar will begin to weaken much more. Now, right now, the dollar is maybe a little bit oversold and can rebound somewhat. But I don't think that dollar is a good value currency in the present environment. So I think dollar weakness will be favorable. I think the debt situation is favorable. And lastly, we talked about the stock market. Now, just consider, people have turned quite cautious already now. And we have almost like a panic among some people, because suddenly they didn't make any money and they're down from the peak in January, say by 10% in their portfolio. Sometimes if they're in technology, more than that. Now, if the market drops 20% and the market has become so big relative to the real economy, I think if the market drops 20%, it will show up in very negative economic statistics. And then, instead of getting QE, this quantitative tightening, they're going to launch QE4, or money print. And I believe that precious metals will pursue the rule.
Now, Dr. Faber, you have talked about recently how you see, you talked about just now about the dollar and how you're not bullish on the dollar. However, you've recently talked about interest rates and how we've been seeing a sell-off in the bond market, and you think there's actually going to be one more decline in interest rates before they go up again, and a decline because you see a recession either later this year or early next year.
Correct. I think first of all, the sentiment about bonds is extremely. I mean, you can open any paper, people will tell you interest rates will go up. And there has been actually already some damage in the bond market, not a huge damage, but some. And I believe that the mindset is the economy will be strong. Trump will make America great again. If you tell people buy sufficient many times, then they believe it. I think his economic policies, if you look at the advisors he's got on the economic side, actually it's quite depressed for me. And I think the economy, look, is also a cyclical question. We are in an expansion. in precisely 3 months, less than 3 months, will be 9 years into an economic expansion and more than 9 years into a bull market. Well, expansions, I'm aware, some people will tell you nowadays, well, we won't have a recession anymore in the US forever. For whatever reason they may tell you. But I tell you, based on historical facts and based on cycle theory studies, recessions come and they go as certainly as rain comes and then it becomes dry and rain again, and the way there is day, night time, and so forth. So I think the probability of a recession, especially given the sharp increase in short-term rates. You know, Milton Friedman said it's not the absolute level of interest rate that matters. What matters is whether money is becoming tight. You can have tight money at 0 interest rates, and you can have easy money at 15% interest rates. The absolute level doesn't tell you anything. And I think liquidity has tightened quite a bit from the very expansionary period that we had between 2008 and essentially 2016.
You had mentioned QE4 earlier, and I was wondering if you think, is it possible in the next recession, if it's big enough, you'll see QE4 and possibly the effort to try and cut rates to not only 0, but possibly negative, you know, in the United States even?
Well, I think that is something that some economists have actually been arguing for and preparing the policymakers and the public that if, say, tomorrow there is a recession, well, the Fed fund rate is only at 1.25%. So they can cut it down to, say, 0. But what then? So the next step will have to be that they can do a massive fiscal stimulus. A massive fiscal stimulus will depends who gets the money, but in theory, if you want to stimulate economy or help people, you could send a check of, say, $10,000 or $100,000 each family. That would then be a truly inflationary policy. But it's like throwing gasoline into a fire. Flames come up, and after a while, you have to throw in more gasoline. Otherwise, fires extinguishes again after a while. So I think that these policies will, at very best, help temporarily. But I think it's on the table that if the economy goes back, they'll cut rates and put them into negative territory.
Now, the last topic.
Then you have to watch what will happen to gold and what will happen to the US dollar.
Right.
Because it's actually fine. If you compare, say, I'll give you the figures. You compare to the 10 years US Treasury, which is yielding 2.77, okay?
Mm-hmm.
Percent. But say Spain is yielding 1.21%,
Mm-hmm.
and Portugal is 1.66. The Netherlands is 0.64.
Mm-hmm.
Switzerland is negative, and so on. Then you scratch your head because you ask yourself, the US has the highest interest rates among these developed countries, and yet the dollar has been weak. Why is that?
Yeah.
What would happen if they push interest rates in the US back to 0? I think the dollar would weaken possibly quite strongly.
Right.
So, I mean, I think the point is, I think we will get a lot of volatility.
Right.
Some people will make money. I think a lot of people will lose a lot of money.
Right.
Because they'll get in and out at the wrong time. And in general, my sense is that the buy the dip mentality is very, sensitive. And that sentiment is on a very near-term basis be a little bit negative, but not negative the way it is near market lows, like in 2009.
Right.
Everybody was so super bearish. They predicted S&P 400, the world would go under, and then that hasn't happened yet.
Yeah, and I remember you in March of 2009 saying it was the low, and you had called it pretty much to the day. I remember that.
Yes. But now the mood is, people say, well, stocks went down, but they always go up. They're a good investment in the long run. And they will tell you the stocks have little downside risk because the earnings are going to expand. But as I said, if the market is down 20%, I'd like to see what happens to earnings.
Right.
All right. Well, Marc Faber, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts you have?